There is no doubt about it. Rising mortgage rates have been a big shock to the U.S. housing market. For the first time since the early 80s, the average 30-year fixed mortgage rate climbed 2 percentage points in just 4 months, going from a little over 3% to over 5%. And that's not only causing some homebuyers to have to settle for less home than they planned on, it's also caused some potential homebuyers to lose their mortgage eligibility altogether because of the debt-to-income ratios that banks use to qualify their borrowers. And in turn, this has caused a whole lot of people to panic and start talking about a housing crash again. So the Fed raised interest rates by 0.5 point in May, and they'll probably do the same thing in June. So now everybody's wondering what that means for the real estate market. And it's not like it was an accident that rates shot up so far so fast. The Federal Reserve is using the interest rate to try and curb runaway inflation. If everything works out, then the higher interest rates will cause home buyers to back off and take a break, and then in theory the housing market will head back to a more normal growth pattern. That's the theory anyway, and hopefully it works out just the way they plan. But for those of you who are panicking out there, take a deep breath and just relax a little, because that federal interest rate increase probably won't spell doom for the housing market. So now you're asking, why not? Well, at the risk of boring everybody silly, I'm going to give you a brief, and I promise, view of how mortgage interest rates work. You see, the Federal Reserve does not set mortgage rates, and the central bank's decisions don't drive mortgage rates as directly as they do a few other things like savings accounts and CD rates. However, the key people in the mortgage industry do keep a close eye on what the Fed does, and it's their attempts to interpret what the Fed does that affects how much you pay for your home loan. See, fixed rate mortgages are tied to the 10-year Treasury rate, not the Federal Reserve rate. When the Treasury rate goes up, 30-year fixed rate mortgages tend to follow along. But rates for fixed mortgages are influenced by some other factors too, like supply and demand. For instance, when mortgage lenders have too much business, they're going to raise rates to decrease demand a little bit. And when business is light, they tend to cut rates to get more business. And then there's inflation. When inflation's low, rates trend lower. When inflation picks up, so do fixed mortgage rates, which is kind of what we're seeing right now. Now, heading into this year, we all knew that the Fed was going to raise interest rates, but I'm pretty sure that nobody expected this. At the beginning of the year, the Mortgage Bankers Association was predicting that we might hit 4% by year's end, and Fannie Mae was only figuring around 3.3%. Well, we kind of blew right by that one, didn't we? Weeks ago. But the good news is mortgage interest rates probably aren't going to be affected too much by the federal interest rate hikes that are coming. That's already been figured in and adjusted for the most part. Lawrence Yun, the chief economist of the National Association of Realtors, said in a recent article that the rate on a 30-year mortgage has risen a whole lot more this year than the federal funds rate has. And he says it implies that the market's already pricing in around 8 to 10 rounds of Fed rate increases this year. So what does that mean in plain English for those of us in the peanut gallery? Well, it means that the mortgage market is already pricing in the fact that the Fed will continue to raise the rate. Which means that if there are no other surprises this year, we should be around the low 6% by the end of the year. Which is a lot compared to the really low rates that we've been used to lately, but not really all that bad when you look at historical interest rates as a whole. Now, I'm not saying that rising interest rates won't have a pretty huge impact on home buyers, because they absolutely will. For an example, let's take a look at the basic Google mortgage calculations for a home buyer who's buying a home for $300,000. Let's say that that buyer has a credit score of 710 and has 20% to put towards their down payment. For a 30-year mortgage at a 3.75% interest rate, which we actually had not long ago, that buyer's going to have a payment of about $1,512 per month. Now, figure that same buyer, but this time they're looking at a 5.7% interest rate, like the one we've got today. That's going to jump their payment to almost $1,800 a month, and that's huge for most people. Or, to look at it another way, take that same buyer buying that same $300,000 home with 20% down. At 3.75%, they qualified for a $240,000 mortgage. Well, today, at 5.7%, they're only going to qualify for a $208,000 mortgage, which is a purchase price of about $260,000. They can't get that $300,000 home anymore. And that will definitely impact housing demand, because a whole lot of people are not going to be able to get what they want in a home right now. Some are going to settle, but some are just going to have to sit it out for a while. So now your brain's probably clicking along going, okay, so demand's going to drop and then the market's going to crash, right? No. Interest rates alone are not going to cause a housing market crash. They will slow it down, like I said, but the current supply of homes available for sale is still so low right now that even a big drop in demand because of higher rates is not going to turn this into a buyer's market. As long as there aren't enough homes to go around, prices are going to keep going up, even though higher interest rates are going to mean that fewer people are going to be able to buy. So yeah, rising interest rates are going to slow down home prices because demand's going to fall off a little. But then as home prices start to ease up, a few more people are going to be able to buy, so demand will go up a little, and so on until the market hits a level plateau. But it's likely to be a slow and steady progression and not a jump off a cliff kind of thing. Now, the second reason that rising interest rates aren't going to have as much effect as some people might think is that we have a huge number of people buying their homes with cash these days. According to Greg McBride, the chief financial analyst at Bankrate, 30% of the buyers in the market right now are cash buyers, and they aren't affected by the mortgage interest rates. And looking at the stats for our local market here in Ocala, that's certainly true here. Locally, we're running just a tick over 34% for cash buyers. So yeah, rising interest rates will slow the market down, just like the Fed wants them to. But demand is still high, and it's probably going to stay that way for a while yet. People got to live somewhere, and let's face it, home buying is largely an emotional decision. That desire to have security, somewhere that's yours, and the sense that you're building something solid for your future and not throwing money away on rent, that's still a very strong driving force for a whole lot of people. Yeah, a whole lot of home shoppers are rethinking their budgets, and like I said, some people are going to get knocked out of the market altogether. But at the same time, a whole lot of folks still want a home to call their own, and they're going to be feeling some serious urgency about finding that home and locking in a rate before mortgage rates and home prices climb even higher. Combine that with the record low inventory situation, and you start to get the idea that housing prices aren't going to crash and burn, and we're not going to be seeing a buyer's market anytime in the near future. So now you're wondering about the R word, and by that I mean recession. Well, if you look at the numbers, out of the last 6 recessions we've had, 4 actually had housing price increases, and only 2 had housing price drops. Those 2 being the one in the early 90s when housing prices dropped a whopping 1.2%, and the one in 2008 that most of us remember all too well. That one was miserable, I agree. But that one was the outlier and not the norm, so I'm not betting on a repeat performance this time around. Now, hopefully, we will start to see a more normal, stable market in the near future, but it may not be all that soon, depending on where you live or where you're moving to. So if you've been on the fence about buying your next home, it's probably time to jump off that fence and start shopping before rates and home prices get any higher, unless you're prepared to settle in for the long haul. And if you're confused and have any questions about how to get started buying that home or how all of it works, just click on the link in the description down there and get my free guide to buying your next home. Or better yet, feel free to get in touch and pick my brain a little. It's kind of what I'm here for. And as always, remember to hit that subscribe button while you're here so you don't miss any of the good stuff.